kind of, if you will, kind of springboarding off of your 5.4% year over year home growth and in appreciation. And I was going to ask you the question, but I just use it as a filler, is for those people who are thinking, well, I'm just going to wait till the rate gets to a certain level and it takes another 3 to 6 months, or even those people who have thought about it and it's been now 6 or 8 months, and we see a 5.4% year over year growth, will they ever catch that perfect storm? Because it's just like I said, it's like chasing the horizon. The farther you go, it never gets any closer.
Yeah, that's exactly right. I mean, you talked a lot about market this time around. At the interest rate level right now, we're starting to see a good amount of homeowners out there bought in the last years at the elevated rate have an opportunity to refi. But unlike past, what's now being called refi boom, I would kind of caution that is, yes, refinance activity has increased. I'm not sure I would call it a boom. What I'm starting to see is some folks who have some money on the table in terms of how much they can save per month. And yet, the amount of savings that they can grab now, somehow in their mind, they've decided isn't good enough, that they want to wait further. And in part, what I'm observing is some of these folks seem to be wanting to hold off because the media has talked so much about interest rates are about to fall, like, for example, the Fed meeting next month. And again, this perception that when the Fed drops the Fed funds rate by 0.25%, or even if it's 0.5%, that mortgage rates are going to follow in similar fashion. That's simply just not technically true. It doesn't work that way. But between that kind of news that is just being broadcast daily about rates are about to fall, and then of course layer into that the coming election, where there's a lot of homeowners out there that think the election is going to have something to do with improving mortgage rates. And so between the two, I mean, I'm talking to some homeowners right now where, in fact, I could think of one where I started the conversation with them in April of this year. Here we are in August going into September. For the last month or so, I've been able to show them that I can save them over $400 a month in their mortgage payment. In fact, about a week ago, I showed that I could save them $525 a month in their mortgage payment. And their reaction was, well, that's great, but we want to wait because our target goal is to save $700 a month. Well, I had to point out to them that to get to $700 a month, we're going to have to see current rates drop to like 5%. And there is no forecast from any major player in the financial markets that is suggesting that we're going to hit that anytime soon. And so it gets into that old saying, right? A bird in the hand, worth two in the bush, right? I argued that they ought to take advantage of these savings now. And if we do hit a 5% level, which probably would take 6 months, probably a year, we hope. And again, that goes against the grain of most of the major players' forecasts. NAR, California Association of Realtors, the Mortgage Bankers Association, Fannie Mae, that goes against all of their forecasts. But if we hit that in the next 6 to 12 months, then they can refinance again, because the refinance transaction is much more efficient than it used to be.
Well, that brings up the point of, like, is there a rule of thumb that someone watching today or they're watching later says, hey, is there a rule of thumb for the rate improvement to justify a refinance?
Well, yes and no. There used to be, decades ago when I got in the mortgage business, there was a rule of thumb that you generally had to see about a 1% improvement in your rate to justify the cost of refinancing your home. I would argue that that's a little bit outdated. I don't think it really holds that well anymore, in part because the cost side of getting a refi is not what it used to be. I think I've mentioned on this program before, years ago, back in the 80s, a 0-point loan, a 0-point rate loan was very uncommon. It just wasn't the case. I mean, I can remember when I just got started in early 1982, every time we originated a loan, there was almost always at least a 1-point fee to the borrower. And that would be on top of the other costs, appraisal, credit report, escrow, title fees, et cetera. Well, the industry has moved to the point where paying points to get a rate, whether it's a purchase or a refi, just doesn't happen anymore. At least it's not advisable, because it takes you too long to recoup that money up front in points from the lower monthly payment from a slightly lower rate. So when you're talking about a 0-point rate, you're talking about closing costs that are relatively modest, even at relatively good sized loan amounts, 400, 500, 600,000. Because of that, you don't necessarily need to see that 1% improvement in rate before you take advantage of it. It really comes down to looking at the specific numbers based on your situation. That's what we like to do. Is if somebody's thinking about a refi, they need to call me with a just a short list of some basic information. I can give a written worksheet that spells it all out, and then we can talk about whether or not the trade-off is there to go ahead and do the refi now, given the costs involved, and improve their monthly payment.
Well, you talked about closing costs, and that brings up the next question is like, when it does come to closing costs, we think of like, a pretty large portion of money, but since it's a refinance, does it come out a little differently? So let's say, for instance, example of those people you said, hey, you could save them $525 a month. If they refinanced right now, and if they refinanced again 8 months from now because the rates went down, like, does that benefit get eaten up in closing costs are too high, or is it because refinance costs are not what they used to be, as you said?
Well, they're not what they used to be, and yet I'm going to throw some shade at the media again. I just read another article about the refi boom is here, but then also arguing about what we're talking about. Is it really a good time now or not? And one of the things that kind of got my goat about reading this article was these estimates of how much it costs to refinance your loan. Part of the article said, the average cost is $5,000. And then another one said, according to Investopedia, that the average cost to refinance your loan is going to be 2 to 5% of your loan amount. Well, if you've got a $500,000 loan, you're talking 10 grand up to 25 grand. Well, that doesn't make any sense at all. That's just not true. Part of it is the confusion between what I like to call, we've covered this recently on our program, what I like to call, and they're technically called the non-recurring closing costs. These are costs, they are fees being charged by what we call service providers, third-party fee-based costs, credit report, appraisal, escrow fees, title fees. All those parties are going to charge a fee, and they have to be paid for. Those are non-recurring costs. Well, on a basic refi for a good-sized loan amount, I would say anywhere from $300,000 to $600,000. Those non-recurring third-party fee-based costs are generally going to average somewhere in the $3,000 to maybe $3,500, $3,600 range. It's not that much. And in most cases, as part of the transaction, the borrower has enough equity that those costs can be rolled into the new loan amount. So other than, say, the appraisal, you're not paying any of that out of pocket. Where the confusion as to how much it costs to refi really makes things murky is regarding what we call prepaid costs or recurring costs. In fact, a refi, if you pursue it this time of year, is a good example. Because if you pursue a refi now and you want an impound account for your property taxes, well, the next installment of property taxes is due, at least in California, a 6-month installment in December. If you're going to close a refinance loan now, let's say in September, your first mortgage payment is not going to be until November 1. Well, that happens to be when that second installment of property taxes for 6 months is due. Well, the lender isn't going to have 6 months of taxes in the impound account when they close the loan, unless they collect that money in advance from you to fund the account. Now so that could be like 7 or 8 months taxes that you're providing as part of your refi to set up the account to prepare for that next installment that's due by December 10th. That amount gets lumped into, on some of the disclosures, closing costs, as if it's a fee being charged to you for a service provided. It's not. It's an advanced deposit towards your future property taxes. I would argue that when you're going to evaluate a refinance, you should exclude those funds from what you're perceiving to be the cost to refi. And one little surprise that most homeowners don't realize, I always try to bring it up. Yeah, it's a bummer. You got to put up 7 months taxes if you want an impound account because of that next installment due in December. But guess what? When that existing loan that's at a high rate that we're paying off, if you have an impound account on that one, you're going to get a refund in about 2 weeks after you close because that loan has a bunch of money accumulated in the existing impound account. And because it hasn't been dispersed on that December 10th due date, when that loan's paid off, surprise, you're going to get a check in the mail for a pretty good amount of money. So that helps offset that cost. Same thing with homeowners insurance. If you're refinancing a loan right now, you close it in September. Well, what if your homeowners insurance policy, your current one, is up for renewal in October? Well, when you close the loan in September and you want an impound account for your insurance, the lender is going to require that you re-up that 12-month premium when you close the refi. Again, that's not a fee from a third-party service provider as a result of doing the refi. It's just your upcoming renewal premium that would have been paid by your existing impound account, but because you're closing the loan in September, it's got to be paid with the new loan closing. And again, the money that's been accumulated in your existing impound account, since it didn't get dispersed to your insurance agent, you'll get that money back too. So once you factor all that in and realize that your actual costs are going to be $3,000, $3,500, then the refinance transaction looks a lot more reasonable, and the amount of time it's going to take to recover that cost through the lower rate, lower monthly payment is going to be a lot shorter than you think.
Well, that explanation right there, it just makes sense. It's like, hey, you're just taking out of one pocket and putting it in another, except someone's going to put some money in your back pocket because you paid it earlier. So I like it. One, just you're going to pay it anyway. As you say, right. These are recurring costs, not non-reoccurring costs.
Right.
And I think that segment right there will probably help alleviate confusion for many, many people who think, God, it's so expensive. It's really not.
No,
it's just it's your insurance and your taxes. Wow, yeah. That's a good point. Well, here's another question: is does it make sense to continue to hold off? And I think you kind of talked about this earlier until their target rate is reached.
Well, again, I've basically already touched on that. The idea here, like that one example of this homeowner I've been in discussions with for several months now, and I have another one, a past client. I closed their purchase loan a year ago. And they're in the 7s, and they're holding off until the election. I guess because they think that's somehow going to be a factor, or maybe there's some other reason why they want to wait till then. But already, right now, today, and I pointed out to them, I can save them almost 1.5% in rate right now. Wow. And that was a conversation I had with them a month ago. So then you start looking at their situation and go, well, wait a minute. I told them in July I could save them a 1.5% in the rate. They want to wait for 5 more months in November. That is a costly decision because you're basically giving up 5 months of lower rate, lower payment, and therefore that monthly savings because for some reason you have this target in the future. Well, not only have you left money on the table you could be saving now, secondarily, you don't really know what rates are going to be in November. I mean, there could be all kinds of reasons why they get worse in November, not better. So again, it's back to that bird in the hand, phrase. I don't understand why anybody, and frankly, most homeowners don't do that. They do. If we can show anybody that they can save $200, $300, $400 a month, at least it used to be very rare for a homeowner not to say, heck yes, let's do it. And yeah, rates get better in another 6 months or a year. And typically you can't refi for 6 months after you get the new loan. But after that, if rates have fallen another 0.75% or 1%, then you can refinance again. Again, the costs are pretty modest, and that usually can be justified if we see that much more of an improvement in that period of time. But if you've got that much to save now today, don't time the market. Take advantage now, and then let's see what happens from there.
Well, I just love the fact that, like you said, you're saving them the rate, which obviously converts into a lower monthly payment, and they're going to wait till the election, which is, a little less than 100 days away, 90 days away. That's 3 more months of payments at the higher rate that they actually lose also.
Exactly.
So it's almost like it's double hurt.
That's a cost.
That's
what I call an opportunity cost, right? In economics, that's a lost opportunity cost. It's just, but you can't twist their arm, and some folks just want to wait. I think, I don't know. I mean, it gets into the politics of things, and I don't want to go there. But I mean, who's to say that whoever wins the election is going to really have that much direct control over mortgage rates? It just doesn't work like that. It's all about the financial markets, financial and economic data points, international events, all those kind of things. So really, nobody has a crystal ball. We just don't know. It's better to take advantage of the opportunity now if it's there.
I like that. Well, my last question is it's more with thinking, hey, should someone consider refinancing if they're unsure they're going to be in that home for a while, or should it even matter?
Yeah, I mean, that's an interesting angle too, and I've seen some articles about that as well. In fact, I saw one writer who suggested, well, if you're not going to be in your home for at least 5 years, you probably shouldn't bother refinancing. Well, again, when you go back to what I described earlier about the cost of refi are much more modest than most people think. And because of that, in most cases, if you have a decent sized loan, now, of course, if you're trying to refinance a loan for 120 grand, a little bit different story. But if you've got a loan amount that's, 3, 4, 5, 600,000, and because the refinance costs, as I described earlier, are pretty modest, it's like the 0% rate, and it's still going to give you a lot of money in rate and payment. Well, then what happens is your recapture period, because you do have to take that into account. How long is it going to take in the monthly payment savings from the refinance at that lower rate to recoup those third-party fee-based non-recurring costs? Well, if it's $3,500 and you're saving $300 a month, well, guess what? You're going to recoup those costs in less than a year. So if you're going to be in the house for 5 years, I don't know about you, but why the heck would you not do that? So this platitude that, if you're going to be in the house for, 4 years, don't even bother. Well, no, it requires a little more focus and evaluation of the numbers to find out if that really bears out and makes sense. And I would argue in most cases, it doesn't.
It sounds like the best thing to do is call the number on the screen now. That's Art's office at 760-969-5023, or call him on a cell phone, 714-612-9035. Let him know you're serious and ask those questions about, hey, are you going to be in the home a long time? What's your rate? Are you refinancing because you have an adjustable rate mortgage? All those things Art will answer for you. And let's face it, you can't make a good decision with lack of information. And so the fact is, it's one of those things when you call Art, he has the question or he has the answers and they are on the house. Art, thank you so much. I appreciate you clearing that up. I think to me, whether it's a boom or not, it's just one of those things like, hey, every case is a little individual, and that's why I should call Art.
Exactly right.
Yeah, Art, thank you so much. Bye-bye.
Right. Okay, folks, now we'll go ahead and finish up our program for today. As you know, we always like to cover a closing question from the previous week. So Jeff's going to go ahead and pull it up now. Actually, this is from our refinance discussion we just talked about. There it is. This is a really interesting question and a good one. Here it is. I remember when 40-year loans were available. With today's higher rates and home prices, they would help with affordability. That's true. Why aren't they common anymore? Well, good question, and here's your answers for that. A few things going on there. First of all, yes, 40-year loans were particularly prevalent and common about almost 20 years ago, actually, frankly, before the Great Recession of 2008. In the early 2000s, with the effort by the federal mortgage agencies and other parties to increase home ownership, which actually, frankly, goes back to the 90s, the middle to late 90s, there was a big push to increase home ownership. And that, as part of that, the mortgage industry developed 40-year loans to help with affordability, to help people be able to qualify with lower monthly payments. But after the Great Recession, the crash of the real estate and mortgage industry in 2008, one of the culprits that were pointed to as a cause of the crash were exactly these 40-year loans, particularly those that had a 40-year term and an interest-only feature. So with the creation of the Consumer Financial Protection Bureau in 2010, 40-year loans were considered, they did not meet qualified mortgage guidelines due to the extended repayment period that presented more risk to lenders. Because the point is, when you're on a 40-year term, almost even more so than a 30-year term, almost all of your payment is going toward interest, and your pay down of your principal loan amount is very, very small. It's tiny. And so what happens is for several years, you're not creating almost any equity from paying down your loan balance. And if we're in an environment where home values are not appreciating, that creates more risk to the lender. So the Consumer Financial Protection Bureau decided that a 40-year loan was too risky because of that feature, and they were not considered to meet the qualified mortgage guidelines that were issued by that agency after the crash. And again, all of those qualified mortgage guidelines were based on a concept called ATR, ability to repay. And so following suit with the CFPB new rules, Fannie Mae and Freddie Mac, the two quasi-governmental agencies, decided that 40-year loans were too risky due to higher interest rates, higher down payment requirement, higher interest rates and slow equity buildup. So as a consequence, those two quasi-federal agencies considered 40-year loans to be non-conforming, which that's a fancy term for saying those two agencies would not buy those loans from lenders. And so as a consequence, that did create a liquidity issue with trying to offer that kind of loan type to borrowers. So as a consequence, since 2010, 40-year loans are still available, but only in what we call the non-qualified mortgage segment of the market. Again, these are loans that are not considered qualified mortgages according to the CFPB, not considered conforming according to Fannie and Freddie. And so as a consequence, you can still get a 40-year loan, but it's considered a non-qualified mortgage type. What does that mean to the borrower? You're going to pay a higher interest rate. You're going to have a higher down payment requirement. There are interest-only options available, but that pushes the rate even higher. So they are available to a limited degree, but only as a non-qualified mortgage. Now, what's interesting about all of this is there is now a move more recently, in particular by the CEO of a nonprofit organization called Operation Hope, that is arguing that 40-year loans should now become the new standard in the U.S. mortgage industry and replace the 30-year loan. So that's going counter-current to what the regulatory environment has been for 40-year loans for the last, almost 15 years. This organization is arguing that we should consider going back to a 40-year loan, have that replace the 30-year loan as the standard U.S. mortgage type based on providing more affordability to home buyers, and in part based on the fact that home buyers, people in general are living longer. So somehow the fact that you're going to live longer should correlate to being able to get a longer term mortgage. I'm not sure what I think about that. In fact, I do know what I think about that. But the idea is by having a 40-year loan, you're going to have a lower monthly payment. It's going to make it more affordable. As to because you're living longer, that makes it more appropriate too. Well, I think that forgets a basic issue, which I pointed out before. Most mortgage loans in the country, and this is particularly true in California, simply don't get paid out to term. Most mortgage loans, particularly in California, usually pay off within 7 to 10 years. So I think that undermines this argument that a 40-year loan is more appropriate because you live longer. Because even if you do live longer, chances are that initial loan you get when you purchase a home isn't going to be around for 30 or 40 years anyway. So in that respect, I don't think it's really a good argument. A 40-year loan is still a pretty risky loan type because, again, you're paying a lot more interest and you're not paying down your principal enough to help protect not only yourself in terms of building equity, but your lender, who's, of course, their loan is secured by your home. So a good question. I hope that helps clear up why a 40-year loan is not widely available. It is, but only on a limited degree as a non-qualified mortgage only. And the trade-off is you're going to pay more, primarily in interest rate and in higher down payment. And with that, we're going to go ahead and close up with our closing question for next week, which is actually kind of appropriate since we just talked about the perceived refinance boom that is coming and all the issues associated. When is the right time to do a refinance and so forth? Here's the question. With rates dropping, we anticipate refinancing soon, and I've heard there is a no closing cost option. Wouldn't that be the best choice to optimize the benefit of refinancing to lower our rate? So next week, I'll have the answer to that question, and it'll be on the house. So in the meantime, hope you all have a great upcoming Labor Day holiday weekend. Look forward to seeing you next week on our Mortgage Minute. In the meantime, so long. Take care. My name is Art Alvarez with MortgageWorks, where we have the answers and they're on the house. So long.